there was two 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, you know, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, you know, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 9.75. He puts me short 10,000 at 9.55 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? That's what you'd expect to pay. No, what are you paying? Less?
No, more.
More? Round turn? Oh, really?
I got the lowest.
Well, you're in the Dow. You're in the Dow Mini. What are you paying for the Dow Mini?
11.
11.
Good morning, guys. Dakota back with another live stream. Today, going to get into the live charts and some back testing again. Like always, still getting knocking off UJ back testing day by day. Just got to stay consistent and get it done. So diving into the charts that I'm paying attention to right now. If you guys do have any pairs you want me to look at before the call-ins, go ahead, type it in the live chat. Also, if you like the stream, hit the like button and hit subscribe. So what we're gonna do, like I said, get into the charts that I'm paying attention to and any charts that we reviewed in previous calls and that are still tracking, which right now that's gold, US30, and Bitcoin. And we have a requested CAD-JPY, but I think that's already played out. We'll check that out real quick. But let's get through my list first. So dollar or euro dollar, I'm looking for a buy here. And you can see I have a reversal pattern here, looking for price to really push up and eventually break this descending channel and just at least push up to this high. For now, on a lower time frame, on the 1 hour time frame, I have a buy setup going on right now, and I'm just waiting for confirmation to actually enter into this trade for this buy. Yesterday it was about a 12 to 1 opportunity, but that was before price actually got to this level. Now the price is at this level. I'm looking closer to a 5-6 to 1 opportunity here. So still a really good move, and I mean just have to wait for those final confirmations to actually enter for it. Alright, let's go to EUR/JPY. EUR/JPY yesterday it hit targets, so this trade's complete. I'm looking for price to come down lower and possibly give me a reversal pattern here. Something that was actually something that had me hesitant to actually. I already took the screenshots. Something that actually had me hesitant to actually enter this trade was a possible buy set up on the, I believe it looks like the weekly time frame right now. Yeah, the weekly time frame. It's a possible buy setup here, but as you scale down to lower time frames, the structure just isn't in line with that. So ended up going with the sells here and just paying attention to this downtrend, and if a buy setup did come, the thing that I wait for is a break of the trend line, correction, and a buy there. And that's pretty much what I'm waiting for now. Break of the trend line, buy confirmation, and then buy up to this zone, or at least to this high. If price breaks below this level, I'm going to continue to look for sales and look for sales at least closer down to this low here. But we do have a major area that we would need to break in that situation. Okay. So if you didn't really understand what I just explained, this is what's going through my head. I want price to come down to this level like I have it drawn out. Let me zoom in a little bit more. Now, if price comes down to this level, I like to see a rejection. This is the first primary setup. See a rejection, a break of the trend line, a correction to a certain level, which has not been defined yet, and then continuation up, at least to that high. And that'll be my next buy. That's a 4 hour, 1 hour setup. Depends what the break looks like. Next setup, if that doesn't happen, break of this demand zone, look for a correction, and then look for a continuation to the downside. Target's going to be short in that situation. I wouldn't really target this area necessarily. I'd watch price at specific levels. And that's pretty much it. Those are the two options, or two scenarios that I'm watching for. Okay, AUD USD. So this morning or overnight, TP1s were hit, and I took partials this morning, like 20 minutes ago before the call, and move stops to break even. So now that that's done, I'll just consider this my stop, and that's where it is right now. Still looking for price to come down. Looking for price to break this level today. Does that line up? Not necessarily. It doesn't. But that would be ideal if price breaks this level. But we've gathered our profits from this position, so happy with the trade. And yeah, let's play out the scenario. Okay, so if price does break this level here, I'm looking for it to hit targets ultimately and come down to this demand zone. If it rejects, I'll look for the break of the trend line, correction, and then look for price to just continue up. That's really it in that situation. Nothing else there for me to do. Euro USD is still scaling down. It hasn't given me confirmation yet. All right, next pair, gold. Gold is still scaling up, almost reached TPs. Let's go down to the 1 hour where the setup is based off of. Okay, so holding two positions. In this, I'm not trading gold live, just to be clear. I'm trading gold on demo, still testing, gathering data for it. I will say, like, it would be like probably the reason I haven't traded gold live. I haven't traded gold live in over like a year and a half since I backtested it. Like the first time I backtested it, like I said, I've said this before, my backtesting wasn't profitable, and I was paying attention to primarily the 4 hour, wasn't going down to the lower time frames, and I obviously didn't incorporate the things that I know and do today. But recently been back testing it, been testing it and forward testing it, and so far been proving profitable. So I may get back on the live list again one day pretty soon. I actually plan to have it on my live list again. Okay, but pay attention to gold. Gold is nearly at TPs, all right? And I actually need to move stops right up here, below that low, below this low. And really within the next hour, within the next 2 hours, I mean, you can't really predict. But about today, I would expect price to actually hit targets if it's going to continue to scale up. If not, if price breaks this trend line, I would close the position. Okay, that's it on gold. And then US 30. And I'll be sure to go back through and send out the screenshots. Okay, US 30. Let's go to the 15-minute. Yeah, let's stick to the 4 hour. No. We're gonna have to go to the 15. It just looks really sloppy to me right now. Okay. So let's just play back. So off the 1 hour time frame, had an impulse and had this expanding triangle actually form for us. Yesterday, price came down to a level where I was looking for a buying opportunity. It looks, since I kept this on, I'm assuming that an entry confirmation actually came and said if we took that position would hit SL, so that's a loss. And yesterday on the call, I actually said buying confirmation actually came and we were a little bit late, but price was still in that area of price. So I went ahead and said, okay, let's say we take the position here, put our stops below the low, and then just target this high here. Okay, so when that happened, so after our entry price scaled down further, and then another buying opportunity came after, and then just gave us that buy there, which only produced a 2-to-1. So this series of trades, these series of trades would have been break even because we had a -1R, -1R, and then +2R. So pretty much break even series, and nothing too significant there. Oh. Something I could have done differently here is not have taken the second position. All right, even though price is in the same area, if price is scaling down, it has potential to revisit the zone and give me a buying opportunity. Now, well, I haven't tested on US 30. What I was about to say is my winners have a specific number, specific drawdown, but I haven't tested that on US 30, so that's something I'll have to test and actually have data to back the decision to not take that trade. Okay, that's US 30. Let's go to CAD-JPY. Okay, looks like CAD-JPY has fully played out. Price came to the top of the zone, scaled all the way back down to the bottom of the zone, and then looking to see if price breaks below here. If it does, looking for it to hit the demand zone. All right, I believe those are all the pairs. Yeah, I took GBP USD off my list. Yeah, we're good. Okay, so I'm gonna go ahead and start backtesting. Play Mark Douglas seminar in the background, and if you guys do have questions, again, I'm not gonna look at it while I'm backtesting. I'll look at it afterwards. In the future, well, let's say once I finish my backtesting, when I finish my backtesting, I'll do more live market analysis and live trading. But right now, I have to find every piece of time to actually get this done, because I want to get it done. It's something that I've had planned for the past few months now, and now I actually have time to do it. All right, I'll talk to you guys in a minute.
That is not the case at all. There were 40, almost 50 brokers in the office, and none of them knew how to trade. Not only did they not know how to trade, Merrill Lynch made absolutely no bones about the fact that we were not traders. They spent no money, no time, and completely discouraged us from even learning how to trade. We were salesmen. We were taught how to talk about trading. We were taught how to talk about investments. we were taught how to, it's called dialing for dollars, to get on the phone and get people to open up accounts. And even though this was unspoken, I'd say the underlying philosophy behind the business was, especially in the commodities business, I'm not talking about the equities. I'm not saying that on the equity side of the business that it wasn't more reputable, but this was about as irreputable as it could be, because the underlying philosophy that we operated from was all commodity traders are terminal, meaning like they have a terminal illness. It's only a matter of time before they want to say all commodity traders are terminal, and it is our job as a broker to make them as comfortable as possible until they expire. In other words, to extract as much money out of their account as you could until they're gone. And even to this day, it just blows me away to think that when I went to a 30-day training class in Manhattan, and there were brokers from all over the world, probably about 80 or 90 of us. And the guy and the person that was the head of Merrill Lynch Commodities at the time, his name was John Conheeney. And when he came in to address our class, and to this day, I don't know why he did this, but he said hi, and he started out with these words: the average Merrill Lynch customer loses all their money in 6 months. And that was the truth. Commodities, not equities, commodities. And that was the truth. That was about what it was. It took about 6 months for people to lose their account, and you just, like I said, you just go to the next one. So here I left this six-figure income to go to Chicago to learn about this business and this industry, and here I'm in a situation, and it's like, it was, like I said, it was appalling, absolutely appalling. So I thought, well, okay, I'll make friends with people on the floor. They must know what they're doing. The floor traders know what they're doing. Well, I found out that wasn't necessarily the case either. Now, it doesn't mean that the floor traders didn't know how to make money. But I'm not going to get into this because we don't have time. But even though what you do is called trading, and what they do, they call trading, the way and the mindset that you have to make money couldn't be further apart, even though they're both called trading. The typical local, the person who traded for their own account in the pit or on the floor of the exchange, the way they made money, weren't trying to make direction-related decisions. In other words, it wasn't the kind of trading where they would find themselves in winning trades that were going in their favor, but that's not the reason why they put the trade on. And like I said, I'm not going to get into the specifics or dynamics of it because it'd take me too long to explain. It just isn't necessary for right now. All I'm saying is that it's a completely, as a matter of fact, before I left Chicago and moved to Arizona, the Chicago Mercantile Exchange asked me, and I worked on it for a while, for about 6 months before I left, asked me to put together a program to help floor traders make the transition from the floor to screen-based trading, because it's a huge psychological leap. It really is. It's a huge transition that has to be made. So what I'm saying is that, not knowing that before I got to Chicago, it was like, here I'm in a situation where I really didn't know anybody who really knew how to trade, or at least knew how to trade in the sense of creating that consistency that we're looking for. It doesn't mean that people couldn't make money. People were making money all the time. It's just that, what's the point of making money if you're susceptible to giving it all back? In other words, if this is your equity curve, and then all of a sudden you're experiencing these huge losses and huge drawdowns, not only is this certainly damaging financially, but it's also damaging emotionally. And it can be very difficult to recover from. These are what I call the boom and busters. Okay, you basically had traders that fall into three categories as far as equity curve is concerned. You've got your consistent winners, the people who have the traders You've got your consistent winners. Now, it doesn't mean that there aren't drawdowns here, okay? But what do you think these drawdowns would be a reflection of for the consistent winners? Consistent winners take losing trades all the time. But their drawdowns are a reflection of what? Anybody got any ideas?
Good money management skills.
Yeah, money management skills. Capital preservation. Okay, these are two good answers, but not the answer I'm looking for. Their drawdowns are simply a reflection of the normal losses that any trading methodology will incur. There is such a thing as normal losses. You don't have to write this down because we're just starting to scratch the surface. We are going to go into this in far more detail later on. So, I mean, if you guys want to write it down, that's fine, but it really isn't necessary. Okay? Normal losses that any trading methodology will incur. Then you've got people who learn something about how to trade, who acquire a good methodology where it is possible, based on that methodology, to experience a consistent income, but your equity curve might look more like this. Most people who are experienced the boom and bust cycles, these are the bust cycles, would say that something happened in the market to cause this. What you're going to find out today is that it is not the case. Even though it may seem like it, it is not the case. These are virtually always the result of trading errors, what I call trading errors, which we're going to go into in detail later on. One of the, just for the gentlemen, few people back here that don't have any idea of my background, I'm going to go a little bit further in it, and I'm just going to jump ahead for a second. I ended up being a trading coach, and working with. I was a trading coach for probably about 17 years. I don't really do it much anymore. I just pretty much focus on my own trading, but while I was, especially in the, throughout the 80s and most of the 90s, I worked with a lot of floor traders, and we talk about boom and bust. There was one of the floor traders I worked with was probably one of the 5 biggest bond traders at the Chicago Board of Trade. And when I met him was in around May of 1992. And from January of 92 until the time that I met him in May of 1992, he had around, this is a guy that just traded for himself. He didn't trade for a firm. He just traded his own account on the floor of the Chicago Board of Trade in the bond pit. He had $12 million roll in and out of his account. And he had a particularly bad day, and he ran into somebody who attended one of my workshops and said, hey, you should go see this guy. He called me. We had a few appointments, didn't really go anywhere. And the next thing, about a month later, I get a frantic call from his wife, who I hadn't even met, didn't even know who she was. Got a frantic call from his wife that said, they're going to lose their house if I don't do something with him, okay? He had another real bad day. So anyway, I started working with him in July of 1992. And from July of 1992 until the end of the year, he ended up the year with almost $6 million. Now, that may not seem like a lot considering he had these swings, but he'd never finished a year with more than, I think, around $650,000 or $700,000. So he had just under $6 million. And so then he went on vacation. He happened to take a book with him called The Coming Collapse of the Bond Market. And this would have been in late December of 1992, early January of 93. And came back. Now, if anybody remembers the bond market back then, it rallied to spectacular heights. But in the meantime, he'd read this, The Coming Collapse of the Bond Market, so he was going into the market every day short, okay? And pissing away this $6 million until he got to the point where he had about 2 of it left. And took him about, I don't know, until maybe mid-February. And he was so exasperated that he said, hey, you know what? I'm willing to do anything. Okay, now keep in mind, I'm willing to do anything. And it wasn't lip service. It was real. It was genuine. It was sincere. And I said, if you're willing to do anything, then here's what you have to do. what I've been working with him, what I noticed is that he was able to stay focused really for not more than about an hour a day. Now, this guy loved trading. I mean, he just loved being in the pit. He just loved every part of it. He just had the hardest time tearing himself away. But if he really wanted to make consistent money, then I felt that an hour a day was about it. Because after an hour a day, he'd start losing, his focus would start to diminish, and then he'd also start to get reckless. He was the kind of guy, and this here again, this is very difficult for people to comprehend, but it is the absolute truth. He was the kind of guy where, when I was working with him during that period, in the second half of 1992, where he would have he'd have a $500,000 day winnings. He'd make $500,000, but when he called after he was out of the pit to have his consultation, he'd be real angry with himself, because he, up to about 5 minutes before the close, he was up $500,000, and then he'd piss away about 175 of it. So it only ended up with $325,000 for the day. Now, this is just like a normal guy like us here in this room with $325,000. And this was not an abnormal day, but he's real angry with himself because he pissed away that 175. And then the next day, he'd do about the same thing. He'd make 400 and piss away maybe 2 at the close. And then the next day he'd make 350 and then piss away another 150. He's got spectacular wins up until Friday, but this accumulated anger that he was building up throughout the week, Monday, Tuesday, Wednesday, Thursday, by the time Friday rolled around, he'd lose $1.5 million. And then start the cycle all over again. So now it's like I'm saying, you know what? Especially as a floor trader. As a floor trader, you really have to be focused. When you're trading at the level that he traded at, where you're trading hundreds of sometimes thousands of contracts, if anybody knows anything about the bond market, we know that one incremental price change in a bond contract is $31.25, okay? You guys with me on this? So this would be a tick. So in other words, if the bonds went one tick up and you're long one contract, you'd make $31.25. If it went down one tick and you were long one contract, you just lost $31.25. He would trade 1,000 contracts at a time. That means one incremental tick price change was $31,000. $31,250. Now, if anybody's ever watched the bonds move, you know that it can move 5, 10, 15 ticks like that. Not only that, there can be what's called price vacuums. Everybody familiar with a price vacuum? You know what I mean by price vacuum? It means that if the bonds are at let's say 106.10. You guys are probably not familiar with bond prices. 106.10, that was the last posted price. That something can happen and you're long. Something can happen where there are no more offers and the next posted price is 106 even. That means the market went down 10 ticks without there being any trades between 10 and even. No trades at all. Which means if you're long, you just lost in that instant $31,000.25 on 1,000 contracts. This is quite common. So you really have to be focused. It would be like when you're trading at this level, I would make an analogy. It's almost like, there's a couple of analogies. One, it's like if you're in an NBA playoff, it's the finals, it's the last game, 7 games, it's 7-game NBA Finals. 1 minute left. The score is tied. The coach is going to send somebody in who's really focused. If the coach thinks you're distracted and you're not on your game, you think you're going to get in that game? This is the way to be in these kind of circumstances in the pit. That's the kind of mindset that you had to maintain. Because even if you were distracted and turned away, there could be bids and offers that would have gotten you out of your trade that all of a sudden dry up. Meaning when guys are bidding and offering in the pit, they're using hand signals and they're telling you they want to buy or they want to sell and how many. And there's hundreds of guys all around screaming. Now, these bids and offers can dry up because when you make eye contact and you point, you say, okay, we've got a trade, and then you write your trade down on your trading card, or now it's an electronic handheld device. But otherwise, you make a trade, and then you could be out of your trade and take your profits. When these kind of things happen, these price vacuums, you could be in bad shape. And just be a matter of just a momentary look away. The guy that you were going to use to get out of your trade is gone now. He put his hands down. Uh-oh, I'm in trouble. Well, what I found is that he could maintain an ideal mindset for about an hour a day. And so that's what I said. If you're really sincere, if you really want to do anything, you can only trade an hour a day. And he agreed to it. And he said, what hour a day? I said, it really won't matter. And it really didn't. He was convinced initially that what hour he went in would make a big difference. It really didn't make any difference at all. He was so good. As a matter of fact, there were other bond traders that I work with that said that watching him trade would have been the equivalent of like watching Michael Jordan play basketball. He was that good. And so he did. He went in just 1 hour a day. And because he knew that he only had that 1 hour, he was really focused, and he was averaging $175,000 for that one day, or for that on an average for that 1 hour per day. Okay, but that would be an example. He would be an example of an extreme boom and buster. We're going to have that concept down in their brain about boom and busters. Okay, and then what you have is the consistent losers, people whose equity curve looks like that. Now, just to get back to my situation, when I went to Chicago, I'm thinking, okay, I've got quite a bit of money. I sold my interest in the agency, but at the same time, I had a pretty expensive lifestyle, as you can quite imagine. I had a house in Michigan that. I had a girlfriend, a very high maintenance girlfriend, and her two daughters were living in, and I had a very expensive apartment in Chicago and a Porsche, and I had the life, okay, and I was going back and forth every weekend to visit them. So really, my situation was, I couldn't maintain that kind of lifestyle with the money that I had without being successful as a trader. And that was the whole idea anyway. I thought, okay, I'll make whatever shortfall that, I end up with as a trader. And interestingly enough, I had to have my trading account with another brokerage firm secretly. I couldn't trade through Merrill Lynch. And there wasn't anybody else in the office who traded their own money. I was the only, unless they were doing it secretly and didn't tell me. I was the only person in the office who was actually trading their own money. Who actually traded, period, other than putting on trades for their customers. So what ended up happening is that, and another part of this is that I also had this, I can't really tell you why I knew this, it's just that I did. It just made sense to me. It just never occurred to me that trading was anything other than about psychology. I mean, the first trading book I ever bought was actually the very first book on trading. The first book that was devoted specifically to trading psychology, which was Jake Bernstein's Investor's Quotient, that came out in 1980. And there weren't that many trading books even available back then. And that was the first trading book that I didn't buy a book on technical analysis. I bought a book on trading psychology. So I was not only immersed in the concepts of trading psychology virtually right from the very beginning, I was also keeping very extensive journals of my thinking process, what was going on, what I was observing from other brokers, in the Merrill Lynch office, as well as what I was observing from interacting with my customers. And I noticed we were all kind of conforming to the same patterns, the same problems. But just say that because I did have this kind of foundation, to understand that it was basically psychological in nature. Because one of the things we're going to talk about, when I get into the skills section of the presentation, is that when you look at trading skills, it's like, well, what kind of skills are we talking about? If we're talking about thinking like a professional, we're implying that the skills are all mental in nature, and they are. Because when you really get right down to it and you really start to think about it, what physical skills are necessary to trade? But we're not talking about a golf swing or a tennis racket or any other kind of physical endeavor that we're familiar with. What kind of skills what does it take physically to put on a trade?
A mouse click.
A mouse click, that's it. Your ability to move the mouse and click it on the buy or sell button. It's that simple. And as a result of it being that simple, it's easy to think that, oh my God, trading is so easy. It isn't. As you well probably know, whether you've been at it a long time or even a little bit of time. There are some very sophisticated psychological skills that you have to acquire to get this kind of an equity curve. And virtually all these skills are founded in learning how to trade without fear. That's basically what this whole workshop's about, is learning how to trade without fear. Because that's what's going to screw you up on virtually everything. Everything that you can do wrong as a trader is going to be the result of what you're afraid of and the effects that fear has on your perception of market information. So with my situation, it's like here I'd given all this up to go to Chicago to learn how to trade, to find out that the only people who really knew how to trade back then were people that I didn't have access to. Meaning there were some big names in the industry who never really took the time or expended the effort to find out exactly what it is that allowed them to create a consistently rising equity curve. What they would say is, well, yeah, you got to go with the flow. The trend is your friend. Cut your losses, let your profits run. There's all these neat little phrases, but it's like, who in the hell knew what that meant and how to do it? Yeah, it sounds great. Cut your losses, let your profits run. Oh, even cutting your losses it can be extremely difficult to learn. Letting your profits run can be 10 times more difficult than learning how to cut your losses. In fact, it's one of the most difficult things to acquire in terms of a skill is learning how to let your profits run. So it was like all this was kind of building up, and my lifestyle was draining my money away. And one of the things that I would say characterized me back then, if I was probably obsessive about anything, it was my credit. It's like my credit was as far as I was concerned, it was like the most important thing in life is to have flawless credit, not just, flawless. And here I'm in a situation where I am truly running out of money. And my trading losses, it wasn't really like I was losing a lot of money trading because I'd really stopped the hemorrhaging. I wasn't trading in a way where I was actually losing money, but I wasn't making any money. And it's like there was always this little voice in the back of my brain, it would come to the forefront of my consciousness that would say, Mark, this ain't adding up. There's something wrong here. There's something wrong. It's like it's not adding up. And then I kind of shove it back there and, it's going to be all right. I'll figure it out. It's going to be all right. Eventually, it got to the point where I was literally out of money. And the only choice I had was to file bankruptcy. Fortunately, I was in a situation where I had two residences, one in Chicago and one in Michigan. And so I had a choice of where I filed. And of course, I filed in Michigan because if Merrill Lynch would have found out, they probably would have fired me. As a matter of fact, nobody knew what had happened. Nobody knew in Chicago, nobody that I knew in Chicago knew what had happened. So I filed in Michigan, and I'm thinking, literally, because of my attitudes about credit, I'm thinking, if I've got to do this, I'm going to fall beneath the cracks of society and never reemerge. I really believe that. I honestly, God, really did. I just didn't see how it's possible to live after having to do something like that. And of course, what I found is that, and when I ended up, what I say in The Disciplined Trader, and I don't really go into a lot of detail in The Disciplined Trader about this, but just to say that what I ended up with was really, I had an apartment, I had my bed and my TV, and when I filed, I was still current on everything. I wasn't even late one day on any of my bills. As a matter of fact, I even called the finance company to come and pick the car up. But I wasn't even late a payment. I said, you know what, I can't do it anymore. You're probably going to want it back anyway. So, it was like, come and pick it up. And of course they did. And you guys, there's a funny story about that. I've never told anybody this, but you guys want to hear a funny story about that? When the guy came to pick it up. And so I'm thinking, because we're in front of the apartment building, and I'm thinking, well, if he's going to pick this up, then I ought to get some sort of receipt that it was in perfect condition, because I don't know what the hell he's going to do to it I don't know. So it's like, and the guy wouldn't give me a receipt saying that, and so I wouldn't give him the keys, and so so he called his boss, and I heard his boss on the other end of the line screaming at him, "You do whatever he wants to get those keys," Just like, and he said something else I'm not going to say for this particular presentation, but yeah, it was like, they just someone's willing to give you the car, but they don't even have to go repossess it. It's like, hey, give them the receipt. But in any case, what I realized, now you think about this, it's like when you define yourself based on your possessions. Just like anybody that loses anything, you've got an internal representation and you've got an external representation. And now there was a discrepancy between what was outside of me and what was inside of me in terms of the way that I define myself. And so that has to be reconciled. And what I realized, and it didn't even really take that long. I don't remember how long it took, but it was like, one, I still had my job at Merrill Lynch, and so as a result, it's like I'm starting thinking, okay, well, things are going to be all right. I was in my worst fear. That was my worst fear. When the fear would creep up into the forefront of my mind, I was like, that was my worst fear. Now I'm in it, and I'm realizing that, I think I'm going to be all right. I'm healthy. I can still think. I'm going to be all right. And when I came to this realization that I'm going to be all right, this is when things change for me as a trader. And this is the interesting part about my situation that most people don't have the benefit of experiencing. There are two things. One, I had this foundation of knowing that it was all psychological anyway. So I had all these things that I'd been working on up to that point. And two, when you tap out as a trader, when you really tap out, you don't get to trade anymore because you don't have any money, right? But I was in a situation where I still got to trade. Even though I was working with other people's money, I still got to trade every day. And so as a result of experiencing my worst fears, coming to the realization that I'm going to be all right, and then at the same time, being in a position where I'm able to interact with the market, it was like, because I didn't have anything more to lose, I didn't. It was like this, the market completely changed for me. It was like I had these blinders on that all of a sudden just came off because the market was different, because I wasn't afraid anymore. I was seeing the same patterns over and over and over again beforehand, but I was seeing the same patterns differently. I was seeing the same patterns from a, let's say, relatively carefree state of mind. And that relatively carefree state of mind allowed me to like say, flow in and out of my trades with an ease and effortlessness that I would not have been able to imagine beforehand. And then what happened is that I started making consistent money for my customers. And there's even, well, there's one really, as a matter of one really good story where, I mean, there are a lot of good stories that I can tell you about my customers at Merrill Lynch. But in one case, I inherited this guy who at the time was the head of the state of Illinois' mainframe computers, and he was from India. And he had put together his own trading program, and he was using the state computers to do it. And so, and he had an account, technically an account with Merrill Lynch, but it wasn't funded because he'd lost all his money. But he still maintained the account. And so I inherited him as a customer, and he would call me every day. And he was just like, and all he would say to me is like, I'd pick up the phone. He wouldn't say, hi, how are you? He'd say, give me data. Like give me the high, low, and close. And, so we interacted like this for a long time. Well, he came up with his own day trading system that eventually, well, because he and I started working on it together, he had the internal program for it, but he didn't have any money management parameters for it. So after about 2 or 3 months of working with him on it, we came up with some really good money management parameters. And then all my customers started trading it, and we were making consistent money day after day, even to the point where Merrill Lynch was starting to take notice. Here all this whole his customer base is making money, and he got to the point where he's thinking, okay, all these people are now deriving this benefit from my work. I should be able to do it too. And he talked his wife into letting him put $5,000 into his account to fund his account. Now, I didn't know what happened to him. Why? I mean, not like we had personal discussions, so I don't know why he didn't have any money in his account. The guy was a maniac. It was like he put the money in his account, and 2 days later it was all gone. It was like he'd call me up and he'd say, okay, do this. I said, well, wait a second. The system says to do this. No. I don't care what the system says. This is what's going to happen. He didn't follow any of his own rules. Now here we had a track record. We had a legitimate track record, bona fide, real money. Day after day. He gets a few bucks in his account, and it's like he thinks he knows where the market's going. Like I said, he was gone in 2 days, and that was it. It was all over with, because at that point, he was done. I didn't get the system because it was in his mainframe computer at the state of Illinois, and had no more contact with him. And shortly after that, ended up getting fired from Merrill Lynch anyway, because there was one of these management consultants that came in from New York, and she was going around the office talking to all the different brokers because of whatever it was that they were trying to find out. And she got to me, and by that time I was already writing The Disciplined Trader. And I just I started very exciting to say, oh yeah, this is what I found out, and this is what I've learned. And her eyes lit up saying, this is exactly what we're looking for. And she was we talked for probably about an hour and a half, and she was all excited. And then she said, I got to go tell, well, I'm not going to say his name, the office manager, okay? And she walked away from me, walked over to the office manager. 10 minutes later, he came over and said, pack up your stuff and get out. Right then and there on the spot. Pack up your stuff and get out. So that's how I ended up actually being a trading coach, because by then, floor trade, because I'd made friends with floor traders, I was making friends to find out how they trade and that sort of thing. Well, they started coming to me for advice, even while I was at Merrill Lynch. And because it's a pretty small community, the word gets around, especially when people are really genuinely helped with the kind of advice that you're giving them. And I'd helped several floor traders turn their trading around. And so what had happened is I started getting hired by clearing firms. What I mean by clearing firms is that to trade on the floor of an exchange, you have to clear your trades through a financial institution. And so, it's like these are traders just like you. They have their own account, but what they have to do is they have to clear their trades through, like I said, one of the major clearing firms at the exchange. Well, what would happen is this, that it isn't like this now, but back in the early 80s or the mid 80s, clearing firms were in some ways like almost like family operations, where the people who owned the clearing firms, they knew all the floor traders, they were friends with them, they partied together, Christmases and holidays and that sort of thing. And so if one of the floor traders would go debit, you know what I mean by go debit? In other words, you have to have a positive balance in your account. Well, the problem with floor trading is that not today, but back then, when you traded on the floor, you had to record your trades on a trading card. So in other words, if you and I are entering into a trade where I'm going long and you're going short, what I would do is that we would take our badge, like the acronym of our badge, and our clearinghouse number, record it on this card, and how many contracts we traded. Let's say you're short 10 and I'm long 10, and the price that we traded them at. Well, those cards didn't have to be turned in until the end of the day. And then they'd all get reconciled, meaning that between all the different trades and all the traders from all the different clearing firms, this would all go into a central clearing operation to find out which trades were, to find out who's long and who's short, how much money's coming out of whose account, and whether or not they were what are called out trades, meaning that you thought I said 10, and I thought we were doing it for 100. Okay, so now we've got a discrepancy of 90 trades. These were called out trades that had to be reconciled before the open of the next day, which is a whole nother world. We're not going to get into it. All I'm saying is that it would not be unusual for guys to overtrade during the day, and the clearing firm wouldn't even find out about it until the end of the day. For an example, one of the guys I worked with at Merrill Lynch, eventually he was a mathematics professor. He's a really nice guy. Should not have been a trader at all. Had absolutely, anyway, and P's at the Chicago Mercantile Exchange, and he was a one-lot trader, meaning, just traded one contract, one in and out, one contract, and eventually the forces inside of him were building up where he's frustrated with the fact that he can't make a living at it. He's just eking it out, where one day he snapped, and this one-lot trader almost took down the clearing firm. In other words, he's got like several thousand S&Ps on, several thousand contracts, where other guys are into those trades, and the market's going against them. So he almost took down a clearing firm just by himself. So what would happen is that because guys would go debit, meaning they end up in the day lost, maybe they're down $25,000 or $50,000 or $100,000. The guy that owns the clearing firm doesn't want to say, "Hey, you can't trade until you pay this off." They'd want to let him to go back into the pit to work it down. Well, after you got 4 or 5 of these troublesome, or 15 of these troublesome traders that are constantly running debits, you start to get a little worried. And so what they did is they hired me to work with these guys. Most of the information, most of the insight, let's say, that you'll find in the disciplined trader and trading in the zone came from me working with these floor traders on a daily basis. And I'm laughing because obviously it was quite a trip working with these guys, because they are not like you and me. that's really about the best way I can describe it without going into a lot of detail. They're not like you and me. So anyway, this is kind of maybe a long drawn out introduction to the fact that what we're talking about here is that you guys have a really wonderful trading methodology where there is an enormous amount of potential for you to be able to make a consistent income from being able to take full advantage of the potential that this trading methodology offers you. But I would say that it wouldn't be unfair for me to say that there's probably what I'm going to call the profit gap. The gap between the potential and your bottom line results. This is the potential, and this is your bottom line results. Most people think that when they realize that this gap exists, that somehow learning more about the markets is what's going to fill it. And what you're here today to learn is that that is categorically not the case. You have to learn more about yourself and how you interact with your trading platform and the market to be able to fill this gap. There are psychological skills involved. And then when I talk about psychological skills, let's anybody think of an example of a psychological skill? This is difficult. I don't think, I'm not saying that you should have the answer, but can you think of an analogy in maybe in other parts of the way we express ourselves that you can think of what would be an example of a psychological skill?
Anger management.
Anger management? Okay, good. Anybody else? Okay. What about a situation, and anybody watch Wimbledon here lately? Just it was on? I'm not a big tennis fan, but I just happened to be watching it. And because I knew that I was doing this workshop here, this is something that really sticks in my mind. What's the difference between let's say, here, this is even a better example. What's the difference between a pro basketball player who can stand at the free throw line and hit 20 in a row, even 30 in a row, where the thing about the variables are fixed. The line and the basket and the distances, they're all fixed. And they've got the motor skills to be able to hit, like I said, 10, 15, 20 in a row, but they get into a situation where there's 1 second left and the score is tied and this basket is going to win the game and he chokes. That's a cycle. The guy that doesn't choke has a psychological skill that the other one doesn't. Trading without fear is a psychological skill. It is a skill that the professionals have acquired and they have evolved beyond the typical mindset or the kind of mindset that the typical trader operates out of. So when we're talking about trading or thinking like a pro, that's exactly what I'm saying. I'm saying that you will evolve beyond the typical mindset so that you can take full advantage. If this line represents potential, that you can take the potential of your methodology so that you can take full advantage of your methodology. Because it has to do with your state of mind. In this section, we're going to cover the underlying nature of the mental skills that you're going to be learning. And then at the end of the section, I'm going to put these skills within the context of 3 developmental modes that you're going to eventually learn to trade in, which would be first the mechanical mode, then the subjective mode, and then the intuitive. Everybody kind of have a good idea where we're going today? Maybe a little bit better of an idea than when you kind of walked in here? Yeah? Okay? So anyway, what I want to do is let's just go through and take a little bit of an attitude survey here, kind of get an idea where you're at. There are no right or wrong answers here. It's just a matter of what you believe about the nature of trading. So if we just kind of making money as a trader is primarily a function of analysis. Who would agree with that? Everyone, come raise your hands. It's all right. You raise your hands. So you're telling me that only a few people would agree? Part of it? Okay. Okay. I often find myself thinking there must be a way to trade without having to take a loss. Come on, be honest. Come on. Oh, yeah, let's say I find myself thinking that there must be a way to trade without taking a loss, right? Okay. Okay. By the way, the first one of the things. This is a primary. One of the things we're going to talk about a lot of making money as a trader is primarily a function of analysis. That really isn't the case at all, what you're going to learn. In other words, trading is execution. Trading is execution. What you decide to do, of course, is analysis. And the problem is that it depends on what you're using your analysis for. If you're using your analysis to avoid the risk, then certainly making money is not a function of that, because you will virtually consistently lose. But we're going to talk about that more in a little bit, okay? Okay. I have trouble getting out of a losing trade. Anybody here still have trouble getting out of a losing trade? Okay, that's fine. You won't have that trouble after today. I'm really, my goal is that when you walk out of here, you will understand in no uncertain terms that there was absolutely no reason to hang on to what you will define in advance as a losing trade. Do you find yourself planning trades you never execute and executing trades you never planned? That's a pretty common thing that affects most traders. There's always a cost associated with finding out what the market may do next. It's good to think that. That means you're accepting the risk. That there's a certain amount of, cost meaning a certain amount of risk involved in finding out what the market may do next. If I were to thoroughly analyze my trading results, I would find that my average losing trade is much bigger than my average winning trade. Well, a few people in here that might still be falling in that category. It only takes one trader somewhere in the world to negate the positive outcome of any particular trade. Who agrees with that? Anybody? Raise your hand if you agree with that, please. Nobody raises their hand. Oh, this is big. I love it. Thank you very much. Thank you very much for not agreeing with that, because you couldn't be further from the truth. You couldn't be more wrong. This is one of the things you're going to learn. It only takes one trader somewhere in the world to negate the positive outcome of your trade or your edge. That's all, just one. You're going to learn that today. I wouldn't put on a trade if I wasn't sure it was going to be a winner. Who agrees with that statement? Please raise your hand, please. Who agrees with that statement? Good. I'm saying good because what I'm saying is that, yes, there is a gap here that we're going to have to fill between your particular attitudes about trading now and where you're going to end up with, hopefully, by the end of the day. I would answer this question, absolutely not. I wouldn't put on this trade if I wasn't sure it was going to be a winner. I trade from the perspective of I don't know if any trade is going to be a winner. And I don't have to know. As a matter of fact, that is one of the principal concepts that you will have to adapt to become a consistently successful trader. And what the pros have adapted, and the reason why they can do what they do, is because they have learned, not just learned, but they believe, without a shred of doubt, that they do not have to know what's going to happen next to make money. And don't even think about it in those terms. They don't even think about it in those terms. It's not a matter of what's going to happen next. When you understand the nature of how technical analysis, how your technical formulas and your mathematical formulas interact with market behavior and what they can and can't do and what their inherent limitations are, you will also understand that I wouldn't put on a trade if I wasn't sure it was going to be a winner is absolutely one of the worst mistakes you can make to be a consistently successful trader. It is. In fact, it's probably the number one. Kind of perplexing at this moment? Yes? Good. Okay, I always define my risk before I enter a trade. Is everybody here in this room at the point where they always predefine their risk? Who doesn't? Raise your hand. Please raise your hand. I want to know where everyone's at. Come on. It's all right. Okay. Sometimes I find myself blaming the market for what went wrong. Well, let me ask you this. Does anybody feel betrayed by the market ever? Anybody ever feel betrayed by their signal, their technical signal, or whatever methodology that they use? We're going to talk about that in detail too. The more a trader learns about the nature of the markets, the easier it will be for him to execute his trades. Who thinks there's a correlation there, that the more I learn about the nature of markets and price movement, the easier it will be to execute your trades? Who thinks there's a positive correlation there? Okay, again, couldn't be further from the truth. There's a negative correlation there. The more you learn, the harder it's going to be to execute your trades. It depends on why you're learning it, of course, but we'll get into that. To be a successful technical trader, you have to determine what the market is going to do next. I already said that's not the case, so you'll know how to answer that one. But if I hadn't said it, how would you have answered it? Who would have said yes if I hadn't have already told you guys? A couple people? And you came to Houston? Oh, come on. Oh, come on. Okay, trading skills. Who are the professionals? We already talked about that. And why would it be beneficial to think like a professional trader? We already talked about that. What's the answer? Anybody can make money, okay? We kind of already established the fact that anybody can make money as a trader. Yeah, we're talking about consistency. what we want to do is we want to close that profit gap. We want to make sure that our bottom line results reflect the potential of our methodologies. Okay? And that's what the professional has learned how to do. The professional has learned how to close that profit gap. They have learned the appropriate skills to do that. They're people just like you and me, okay? They're no different. They really aren't. They've evolved into a different way of thinking about trading. That's the reason why they can do it. And you can do it too, with understanding and awareness. That is really primarily what this workshop is about anyway. Because when you think about it, if you've read stories of people who have aspired to greatness as a trader, you'll always find, with almost all of them, that there's this underlying thread, this underlying theme that virtually all of them have lost one or more of what they considered a fortune before they started becoming consistently successful. Why do you think that underlying thread or theme exists in their lives? What's that? Why do you think that commonality exists? Because at some point they lose so often and then come back from losing that, one, they gain the confidence that they can do it, and as a result, the fear dissipates. And as soon as the fear is gone, they're trading from a carefree state of mind, and when you trade from that carefree state of mind, everything about your trading changes. Remember that the primary skill that we're talking about here is simply trading without fear. This is a trading skill. It is the primary skill that you will have to acquire to create consistency, to trade without fear. What does consistency look like? I've already went through on the grease board here and showed you a consistently rising equity curve with the drawdowns, the normal drawdowns being a reflection of what? Can anybody remember what I said about that? What that? Normal losses that reflect any trading methodology, right? Okay, what skills are necessary to experience a winning trade? Now, think about it. Now, I'm going to contrast, okay? I'm going to do a little bit of contrasting here. Just to show you one of the reasons why it can be so difficult to get even into a frame of mind where we start asking the appropriate questions about what do I need to really be consistently successful? Because what does it really take to experience a winning trade? What skills do you need? Anybody got any idea? What skills do you need to experience a winning trade? What? What's your name, sir? Maurice says a click of the mouse. Who's with Maurice on that? Come on, who's with Maurice on a click of the mouse? Got 1, 2, anybody else? 3, 4, he's absolutely right. That's all it takes. There are no other skills needed. No other skills needed other than the actual physical ability to put your finger on the mouse button and click in the buy or the sell, and you can find yourself in a winning trade. You can find yourself in a spectacularly winning trade, far beyond what you could have ever imagined. And what skill did it take? What did it take? Just doing it. That's all. Just doing it at that moment. Do you need an edge? Do you even have to know what an edge is? Is it possible to just be to walk up to your computer and the arrow happened to be on the buy button, you click and then find yourself in a winning trade? You didn't have an edge, did you? You just clicked it. What did it take? It took nothing. Do you need a plan? Need no plan. Do you need the discipline to execute the plan? No, you don't need that either, do you? Now, see, you're going to see the opposite of all this, of course, is what we're going to be talking about in terms of creating consistency. But go ahead.
What you're saying is a blind squirrel will eventually find a nut. Sorry. What you're saying is a blind squirrel will eventually find.
Did you say a squirrel? I'm sorry, squirrel.
Squirrel.
Okay, squirrel. Okay, go ahead.
Yeah, I can click a mouse. The arrow hits the buy. I click. I get a great trade. That's good. It's all the things that lead up to me. That's the implementation. But what about all the things that lead up to that implementation?
Oh, I understand. I'm not negating that at all. I'm just saying that the reality is you don't need anything. That's all I'm saying, because I'm contrasting here. I'm just making a contrast. between what you need to be consistent and what you need to win.
Oh, okay.
That's all I'm doing, okay?
You just summed that up with what I was about to say. There's all the difference in the world between having the skills necessary to experience a winning trade as compared to having the skills necessary to consistently experience a winning trade.
Absolutely. That's all I'm talking about here. Because see, because what this does is the not understanding this contrast creates what I call like a huge psychological gap. Because it's very easy for us to think that trading is easy. And if you believe that trading is easy, even if all your experience is starting to tell you that it's not, it doesn't mean that experience is dropping down to a level of realization where you change your behavior or change the way that you think about trading. If your first impression, if your first experience was that this couldn't be simpler. And then you spend, how many X number of years or half a lifetime finally coming to the realization that, you know what? Yeah, to win, like what do you need? Like I could be in a casino and plunk $100 bill down at a blackjack table and end up with a blackjack. What did I need? Nothing. I just happened to win. Now, if I want to be a professional blackjack player and make a consistent income from playing blackjack, well, that's a whole nother matter, isn't it? And we're talking about the same things here with trading. There'd be a number of skills that I'd have to acquire to be able to make a consistent, reliable income as a blackjack player. And there are people who do it. Do you need a good reason to put the trade on to win? Do you need a good reason? No, not at all. What characteristics distinguish the pro from the typical trader? Well, they plan their trades. No. They execute their plan without error. We'll talk about trading errors in a minute. Big difference. Okay, they can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. Okay, what do you need to achieve consistent results? Well, you're gonna need an edge. You're gonna be able to identify an edge. You're gonna have to have a trading methodology, are you not? Right? Okay? And you have to have a plan on how to utilize that edge. In other words, you're gonna have to determine risk parameters. How much does it cost me to find out if this particular edge that my methodology provides me, how much is it gonna cost me to find out that this edge is working on this particular trade or not? That's your risk parameter. Are you guys with me on this? Okay? Money management parameters. In other words, how much in other words, contract size or number of shares that you trade. All this has to be taken into consideration. You could have a standard amount, or you could have an amount that fluctuates based on other criteria that you use, to determine, the level of trade that it is. Like it could be like a 5-star trade or a 1-star trade. With a 5-star trade, you go in with a maximum position. With a 1-star trade, you go in with a minimum position. And profit objectives. You have to be able to set profit objectives. See, just having a methodology to get you into a trade is not enough. You have to be able to determine what the risk is on a consistent basis. You have to know what your money management parameters are, and you have to be able to determine where to take profits. None of these are easy things to do, are they? Trade execution. The ability to execute trades flawlessly so you can utilize your trading plan to its maximum potential. This is the big one right here. This is the area, because when you get right down to it, trading is execution. The act of trading is executing trades. And if you're going to execute trades, you're going to have to be able to do them without errors, because it doesn't make any sense to think that you will achieve a consistently rising equity curve if you're constantly making trading errors. Trading errors would be defined as mistakes. Mistakes that detract from your bottom line results. Now, the interesting thing about mistakes is that when you're trading from let's say the perspective of, it doesn't really take anything to win, then there really aren't any mistakes that you can make, because anything that you do could result in a winning trade for any reason. when we're talking about making consistent money or an income that we can rely on, then everything changes about this. Everything changes. What I'm talking about here is I'm talking about these like 5 or 4 broad skill sets to be able to create consistent results, the kind of results that you can rely on as an income. You're going to have to learn an edge. You're going to have to acquire a trading methodology that gives you an edge. I'm defining an edge as that there's a higher probability of one thing happening over another. That's what an edge is. And we're going to learn the nature of probabilities here in a moment. You're going to have to have, you're going to have a plan on how you utilize that edge, meaning what the risk is, position size, and profit objectives. Then you're going to have to be able to execute. You're going to have to get to the point where you can execute that edge without making errors. For you to be able to execute that edge without making errors, you're going to have to learn how to trade from a carefree state of mind, meaning you're going to have to aspire to the point where you can trade without fear. And to trade without fear, you're going to have to learn how to think in probabilities. That's basically where we're going here. And I said this primary skill was learning how to trade without fear. Learning how to trade without fear is a function of learning how to think in probabilities. Meaning we're going to set aside or move from thinking in a trade-by-trade mentality. In other words, what this trade is going to do for me right now, am I right or wrong on this trade? And we're going to move to a series of trades perspective, because that's what your methodology does anyway. Any trading methodology just gives you a win or loss ratio over a percentage of trades. In other words, if I take the same criteria that's in any kind of any kind of technical formula that's mathematically based, or a technical price pattern that you would be able to see visually, what we're going to learn is that my edge, meaning a higher probability of one thing happening over another, is simply going to give me a higher win rate over a series of trades. Let's say the next 20 trades. 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. And that the actual, on a trade-by-trade basis, I don't know which one's going to win or which one's going to lose in advance. There is no way for me to find out. There's no way for me to determine that. That on a trade-by-trade basis, no matter what reason or rationale that you come up with, is that there is no way to assure yourself that it's going to be a winning trade. There's nothing that can tell you that. That trading methodologies give you a win percentage, let's say 70% of the next 20 trades are going to be winners. There's no way I'm going to know which of the 70, which 12 or 13 are going to be the winners, or which 6 or 7 are going to be the losers. What you're going to learn, and this is what the professionals have learned, is that there's a random distribution between wins and losses over any given set of criteria that define your edge. There's a random distribution. I will get a higher percentage of wins to losses, but I just don't know which trades are going to be. It requires a complete shift in the way you think about trading. When you make this complete shift, everything about your trading will change. Now, I'm expecting you to make it now because we're still in the introduction. We won't really get into the meat of this until a little bit, but this is where we're going, okay? That's all I want to get. This is where we're going. You're going to genuinely learn how to think in probabilities. Because when you have genuinely integrated these concepts into your mental system at a functional level, your fear will go away. You do not need to lose everything to get to the point where you can figure out that, I've got nothing to lose anymore, so I don't have anything to be afraid of. You don't have to do that, okay? You don't have to do that. All you have to do is commit yourself to learn how to think about trading in another way, and your fear will go away. Because what we're going to learn is the correlation between what we believe and what we feel. There's a direct correlation between if I'm going into a situation with a certain belief that, let's say, that my particular edge is going to tell me what's going to happen on this trade right here, I wouldn't even put this trade on unless I thought it was going to win. When you really understand the nature of price movement, which is what we're going to get into after we go through this section on skills, when you really understand that, you will never think that way again. When you really understand the nature of price movement, you won't think that way again. And that is one of the biggest problems that the typical trader has. Let's say the typical screen-based trader is that they really don't understand the nature of how prices move and the underlying dynamics, because you haven't had the exposure. You haven't had the exposure to the direct markets. Your only exposure has been those blips on the screen. And as a result, there's a real gap in understanding about what's really happening. When you understand what's behind those blips, what's behind those photons that show up on your screen, when you really understand that, you will think about trading in another way, in a completely different way. It won't even occur to you to do some of the things that you're doing now. Won't even occur to you. Okay, now, I've given you 3 so far. The next broad area that you're going to have to learn is like you can be an expert at defining an edge. You can even be able to execute your trades flawlessly, but run into the next challenge, and that's what I just call self-sabotaging beliefs. In other words, all of us have a sense of self-valuation. All of us have this sense that what we're worth as a person, you might say. And if you were to take like an old Ben Franklin accounting scale, okay, and this is positive and this is negative, meaning if you were to list every experience in your life, if you had, let's say, conscious access to every experience in your life that contributed to a positive sense of self-valuation, that yes, I am a worthy person, because what we're running into, I kind of got to get ahead of myself, what we're running into is this, is that when you learn how to define an edge and learn how to execute your trades flawlessly, what you're now exposed to is the possibilities for unlimited wealth. There's really nothing holding you back. Well, let's put it this way. There's nothing on the outside that's holding you back, but there might be something on the inside that's holding you back. Those things on the inside could be self-sabotaging beliefs. In the sense that if you listed all of the experiences that contributed to a positive sense of self-valuation and all experiences that contributed to a negative sense of self-valuation, that I'm not worthy as a person, I feel guilty about this, and this, that you could end up, you can go plus negative, or net positive or net negative. What could end up happening is that if you don't have the, let's say, the skills or the awareness to realize that as your equity curve, as you start making money, these internal forces, if you have net negative, these internal forces start building up to the point where they'll cause you to make unconscious trading errors, where you're not even really aware that you hit the sell button instead of the buy button, those kinds of things. And you have to become aware of when these forces are starting to build up inside of you, and either compensate for it by not trading, to stop trading, or to find a way to neutralize them. And there are various techniques available. But all I'm saying is that these kinds of errors that are the result of self-sabotaging beliefs don't really have anything to do with your direct trading skills. In other words, your ability to identify an edge and your ability to execute your trade. But they can have an enormous impact on your equity curve.
I would assume that you would be monitoring your equity curve, and you would start seeing your curve go down in an abnormal way, and you would start looking for your whatever's happening to you. Let's say you're not feeling well, or whatever. Your wife just divorced you. Or maybe something.
Yeah, these are all good things, right?
Things
that you're bringing up. I mean, these are things that are all relevant.
What I'm saying is, though, you show two extremes, a normal drawdown, and then the boom or bust drawdown. There must be some way to know, at least I'm looking for, to know when you start looking that you're self-sabotaging? That's my question.
Good question. As a matter of fact, there are software programs available now that will tell you that. There are software programs available that will tell you when, in other words, I'll give you an example. I'll give you an example. When I was working with traders, with especially like hedge fund managers and larger traders, there are people, first of all, there are people that their sole job was, if they were, let's say they were central, here, let me think about how important this is. They had, let's say they're in the middle, and they've got, let's say, 10 or 12 money managers. These are guys that all have, they're managing funds, okay? This guy's sole responsibility was to shift money from here to here to here to each manager based on chart patterns of their equity curves. In other words, they would chart the equity of these particular traders just like price patterns in the market to determine their potential for inordinately large drawdowns because of self-sabotaging beliefs. That's how sophisticated the market has become. That's how relevant these issues are. So that you can actually chart your equity, and then you start to go like this. Oh, well, and then do another one like that. Well, something's happening here, okay? I mean, it was really kind of amazing to me when I was working with floor traders especially. I mean, this one guy, this pops into my brain just as we're talking about this. I mean, he came in for a consultation, and he had his worst day in his life ever. Worst trading day, lost more money than what he's ever lost in his life. And I said, well, and it's like normally, almost virtually in every case, something catastrophic's happening in that person's life. But what was always amazing to me is how much of a disconnect that the person would have between the catastrophic event in their life and what they ended up doing as a trader in the market. And I said, well, what's going on? And I just said, well, what's going on? And he's kind of, well, yeah, my wife and I had this really bad argument last night, and when I left for the exchange this morning, he slapped his kids around and he kicked his dog, and it's like, and then he came in and had his worst day and didn't make the connection between what happened at home and what he did on the floor. I mean, he might have felt completely justified with the argument that he had with his wife in slapping his kid around and kicking the dog.
Backtesting complete for the day. I had to stop 3 minutes early because I was getting a little bit too reactive, emotionally reactive, and didn't want the next decision to be based off of just an emotional reaction. I was but it actually happened at least 2 times before during that session, but I was able to take a step back, examine everything that I needed to check off, make sure that I wasn't taking the trades that I wasn't supposed to take, and managing the positions properly. Okay, so let's review. So AUD/USD price is still at this level here. Again, looking for it to break below. If it breaks below, I'm gonna hold this until targets. If it breaks the trend line, I'm gonna look for impulse correction to buy. EUR/JPY is over. Yeah, we're done with this. EUR/USD. EUR/USD is the next buy. Have we got a signal yet? The answer is no. Looking for that buyer. Possible double bottom forming right there. Like to see some rejection in the next few candles. But that's it. Let's look at gold really quickly. My alert hasn't gone off for that, so that means hasn't hit targets yet. Okay, US 30. And I think I forgot to look at Bitcoin when we first started. US 30's come all the way back down. Major rejection level here, so be interesting to see how price reacts to that level again. Lower time frame, even as low as the 15-minute time frame, we have a downtrend here, so we can look for a selling out confirmation here. Something that's going to be a little bit testy, or that would shy me away from that sell, is price hasn't broken this level here. We have a descending channel, which looks like on the 5-minute time frame, an impulse and a correction on the 5 minutes to push up to that trend line. So what potential double bottom forming like right here at this level, and that's actually like a great area for that to form at. Safety, wait for the break of the trend line, a correction, look for price to continue pushing up. What is next? We have Bitcoin, which I forgot to look at the beginning of the call, unfortunately. I actually invested in this. Oh, I was like, why does it look so weird? I was on the 15-minute time frame. Okay, so beginning of the month, not the month. Beginning of this week or last week? Okay, middle of last week. We had this selling opportunity. I was looking for price to come to this level and looking for a buy. Didn't happen. Price broke this high, and we have this bullish pattern forming here for our next buying opportunity. And this is actually the reason I decided to get in. I am actually looking for long-term buy positions here, and been looking for them since down here. I just realized, oh hey, I can actually put money into this. I'm like, okay. So looking for these highs to be revisited and actually not necessarily be broken just yet. Expecting some type of resistance there. I'm not expecting like just huge pushes up just yet, but just being on the lookout for that. Like I said, I do believe like now is a really good time to start investing, and or at least there's some really good opportunities on Bitcoin, especially on a short-term time span. These are really nice buys, really nice uptrend forming, and we have this nice impulse. We just need a daily correction, which I believe I've been looking at for last 2 weeks. That's a very old markup. And that's going to be really interesting. You know what I just did now just gave me an idea, which I need to test as soon as possible, because that's this, if what I'm thinking actually works, that would be an absolutely amazing opportunity, or an amazing approach to NAS. Let's go down to 15. Yeah, and right now it looks perfect, but that's just one scenario. All right, so right now I'm just rambling and jumping back and forth, and which means it's time for me to end the call because I've finished everything, and Euro USD did not work, as you can see, which means gold is likely to push down. Oh man, which means we're gonna have to close gold. If that trend line breaks, I'm closing. All right. But appreciate you guys watching. Hope you guys enjoyed. Hope you guys able to learn something from this call or helped you in some type of way. And I will catch you in the next one. And oh man, I'm back to the old days, forgetting some major important stuff. Now listen very, very closely. There's one thing that I haven't been doing, and I need to do it. If you like the video, please go ahead and hit the like button. Also hit subscribe if you want to keep up with future content, and I really appreciate all the support. Alright, if you guys want to check out the blog post, link to that is in the description. Now, something that I didn't make a note of, or I guess I haven't explained yet. The blog now has like member sections or supporters. So for the people that support and are members of the blog, like our subscribers of the blog, you get the full 25 watch list every single week. Basically the TradeFi thing that I do each week, and or the forecast I do each week. And then like with monthly updates, the monthly updates that I'll be sending out are just free. They're gonna be for everyone, and it's gonna be on my like blogger site and also the Buy Me a Coffee site. So you can check those out. Make sure you subscribe to those, because definitely gonna be some value in there, and there's more value that I'm not going to talk about right now, but some interesting things are already lined up for those for the blog. Jeez, which I want to be really interactive with or and more open with. But I will catch you guys in the next one. Bye.
Well, the market takes your money away until finally something flips you out of that. And you say, hey, you know, you just come back to your senses and you had enough and you get out of the trade. I know that's probably never happened to anybody in this group, but but I've worked with many people who it has happened with. So this is not something unfamiliar to anybody here.
The terror part,
It's like going literally from a state of mind, it's like literally going from heaven to hell instantaneously. And keep in mind the dynamics here. It was all based on your expectation. It's all based on your expectation. So you guys have got this? Okay, so when we're talking about consistency, see, this goes back to when I was doing the contrast, okay, is that to experience a winning trade, you need nothing. I'm not saying that you don't put something into it.